Hello, everyone. Today on the Final Bar, I have a great guest. Jeff Hirsch, editor of the Stock Traders Almanac, is going to be talking to us about some seasonal trends, some recent signals, how we should be digesting these recent moves. A lot of movement this afternoon with the S&P and the NASDAQ accelerating to the upside into the close. Ladies and gentlemen, this is the Final Bar. Hey everyone, welcome to the show. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny and hazy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of technical analysis. The technical toolkit is really designed to empower you to better understand the markets, to understand the message that the markets provide back to us in the form of price and trend and breadth and sentiment, momentum, all those ways that we can quantify investor behavior, investor decision making into price data and really look at those changes, those shifts in sentiment over time. I'm often asked, what's a great way to measure sentiment in the markets? And my number one answer is always price. That's what price tells you. It tells you how people are not just voting with their voices or voting with some survey. It's how they're voting with their capital, which is arguably one of the best motivators for a lot of investors. So by looking at these shifts, what can we learn? On a day like today, very much an offense over defense type of feel to the tape. Some of the growthy sectors like technology, communication services, having a decent update, really accelerating to the upside. The S&P testing 4,200. It didn't quite close above there, but it got very, very close. So we'll look at some of those key levels, see key patterns, and see what signals we can tease out. Let's get right to our market recap and focus on what happened today. Try as much as we can to connect today's price action to the longer-term trends. Looking at the market action again, you can look at the little two-day preview chart. Last couple of days, pretty nice up move, sort of a follow through. And again, it's led by some of the best performing stocks and groups year to date. Areas like semiconductors, like computer hardware and others, doing very, very well. And that's pushing these risk assets to the upside. The NASDAQ composite leading the way higher today, up 1.5%. The NASDAQ 100 actually up a little bit more, 1.8%. The Dow was most of the day actually in the red. So you had that sort of very familiar pattern of the NASDAQ in the green, the Dow in the red, and the S&P in the middle. But everything got dragged up by the close. The Dow actually still finished up about 1/3%. The S&P finished about 0.9% higher, and again, closing right at 4198, a hair's breadth away from that 4,200 level we've been talking about for quite some time. We touched it, just traded just above it briefly, and closed right below it. I think number one question for me going into tomorrow, going into the weekend, do we close above 4,200 or not? Mid caps and small caps both up as well, about the same. No real differentiation between large to mid to small by the time all was said and done here. And the VIX continuing to push back lower. This is one of the lower levels in the VIX that we've seen year to date, down almost to 16. That's after pushing up toward 20 here not too long ago. Let's look at some other asset classes here very quickly. We're going to talk a little bit about the Fed because the futures market is pricing in a higher and higher likelihood that the Fed is actually not done raising rates, but that we might get one more, if not more than that. We'll have to see what the future holds. But currently, the probability of a higher move is starting to increase a little bit. 10-year, 5-year, 30-year, short-term points all moving up. So the entire yield curve sort of drifted to the upside. 5-year yields around 3.7%, 10-year yields around 365. The dollar index moving higher today as well. So again, I love to encourage people not to generalize too much, right? Strong dollar means weaker stocks, means stronger gold, whatever relationships you want to come up with. I would argue those are very fluid intermarket relationships. So in general, the stronger dollar has been rougher for risk assets. However, today, not the case, right? We're seeing major equity averages moving higher, seeing the dollar move higher as well, and bond prices, of course, going lower. Commodities mostly in the red, although you had a couple in the green, but overall the broader commodity ETF, the DBC, was down about 0.9%. Gold prices continue to push to the downside with the GLD down another 1.3%, silver 1.2%, copper 1.3% as well. We're going to look at a chart of gold here in a few moments, and you'll see how quickly we've gone from the upper end of a consistent uptrend channel to now more the lower end of that channel. We're very quickly at the point where we might be in a different regime altogether. Cryptocurrencies taking a bit of a bath going into the equity session. You can see they ripped or turned back to the upside very, very quickly, but Bitcoin currently down around 26,750, we'll call it. Ether just below 1,800. So some of these cryptocurrencies, which had been very, very strong, Bitcoin, breaking above 30,000, Ether above 2,000, all of a sudden coming back and showing some short-term weakness here as we continue on with the active trading here on Thursday. Briefly looking at sectors, as I mentioned, it's sort of the FANG sectors, the growthy stuff at the top of the list today. Technology led the way higher, up 2.1%, followed by communication services up 1.8%, consumer discretionary up 1.6%. At the bottom, it's all the defensive stuff, right? Real estate down 0.6%, staples down 0.5%. Some of those charts in staples, I'm thinking of things like Procter & Gamble, like Coke. These are charts that looked really good up until about a week or two ago, and all of a sudden just starting to come down. They're pulling back from significant resistance levels, and that may be an interesting pattern to watch, because that's an area of the market which had been, incredibly strong relative to other sectors recently. You may start to see a bit more of a rotation as today, consumer discretionary outperforming consumer staples. Utilities down 1/3% as well. I'm going to briefly show a chart of the S&P 500 just to drive home the fact that we're at that 4,200 level. This is that thick green dashed trend line that I've had on the charts here since the February peak. My general argument for this is 4,300 is pretty important. That's where we topped out in February. If you want to look across a bunch of stocks and separate them into the strong buckets and the not so strong buckets, I would argue simply look at where we're at now versus the February high. There's a bunch of stocks that are well above their February high. I'm thinking of home builders and gold stocks, to be honest with you, but also semiconductors and mega cap tech and consumer names and all of those. And then there's a bunch of things that are not, and that'll very quickly help you differentiate between the charts that have been working and the charts that have been stalling out, sort of languishing below their February highs. The S&P has been below, and that's been one of those weird sort of challenges to this market, is a small number, a relatively small number of stocks looking very strong, and they happen to be the biggest names that are able to push the NASDAQ composite much, much higher, and certainly the Qs, the NASDAQ 100. But the S&P's been lagging behind a little bit. You're starting to see that push higher as well, and I think that might be, again, S&P above 4,200, I think feels like a very different market probably for quite a few investors. I mentioned the interest rates and the Fed funds futures. I want to look at the chart of the 10-year just to sort of show you where we're at. So you see bond yields pushing back higher a little bit. Bond prices, of course, coming down. So you have stocks rallying, you have bond prices coming down, and interest rates moving to the upside. What's interesting about that move right now is not too long ago, we were talking about the Fed funds target rate remaining pretty much steady, and assuming that most recent meeting here, this May meeting, was the last hike. And that's pretty much what the futures market was pricing in. Every week, it's seeming to get more and more likely. Now it's about 1/3%. Last time I checked, it was about a 36% probability that the Fed would raise rates again at the next meeting, about a 64% probability that rates would stay the same. And that's using Fed funds futures as a way to sort of interpolate what the probability is of a certain interest rate at a certain point in time. So overall, the market is sort of becoming more and more comfortable with this idea that rates might continue higher. And again, for me, it tells you how much of a question mark there still is with the debt ceiling crisis, if you want to call it that, with just inflation data. And again, we're one bad inflation number away from, I feel like, the market getting very jittery very, very quickly. It's certainly what it has felt like to me. So we'll see what happens there, but it's worth noting for now, interest rates have stabilized and just starting to rotate a little higher. The 10-year yield is back above its 200-day moving average, which might be important to watch. Just want to check in briefly on Bitcoin, just to show what I'm calling sort of a short-term head and shoulders top here. The rally off of the low in November was pretty impressive, and I think this most recent jump from the March low at the 200-day moving average, really impressive. That was from 20,000 to 30,000 in right about a month, which is a pretty impressive move to the upside a 50% gain in Bitcoin in a relatively short amount of time. But look at how quickly we've given back some of those gains. We stalled out at 30,000. We then broke below a trend line using those sort of swing highs, the left and right shoulder, if you will. And until proven otherwise, I see this as a chart sort of distributing. What's interesting is the downside target sort of down in this area, not too far above the 200-day moving average. Do we have another reset, another retest of the 200-day before we would make another leg higher? It's interesting to me as well that as the S&P is testing its February high, Bitcoin, Ethereum are actually well off their April high, right? They actually already had their run off of the February high and now starting to rotate lower. So a bit of a disconnect between stocks and Bitcoin, which certainly has happened before. Let's show the chart of gold here very quickly. So I just wanted to highlight how quickly we've come off of those levels. This is a trend channel that we drew sort of back here as we were seeing this general trend. I used the lows as the beginning, and then I drew a parallel trend line up at the top just to capture most of those highs. And we can see there's sort of this general consistent upswing. And we've spent some time in the upper half of this range and some time in the lower half of this range, most recently back there in February and March. We're very quickly back down testing the lower boundary. And I think what's interesting about a chart that has had this setup is we are right at sort of that decision point, right? Either this is another sort of rotation to the lower end of the trend channel, which would be a pretty ideal time for this to rotate higher and just continue this general trend, this pace of the market that we've seen off of the September, October, November lows, or we start breaking down through this trend line. We've already gone below the 50-day moving average. Yesterday, we closed below it here today with another gap lower for the GLD. I'd love to see if we could get below that trend line, and if so, all of a sudden I'd have to not label this probably that sort of trend channel anymore. I have to come up with a different way of describing this action that we've seen. Also note the bearish momentum divergence we've seen. March, April, May, higher highs, lower peaks in momentum, which is a cause for concern. That seems a little too depressing before the break. So let's show a chart like Netflix. There are stocks breaking out. Don't worry. It's not all bad. It's not all things moving to the downside. The Netflixes of the world, what's interesting is these are the stocks that have been lagging behind. The other FANG stocks, things like Apple and Alphabet and others, have had these really good runs, while the Netflixes and others have been lagging behind a little bit. A gap higher today, of course, with some updated subscriber numbers, testing that high from February. But overall, is this chart more likely to break to the upside or retest the lows? And at this point, given the momentum, boy, it certainly feels like we're making a run at those February highs. That might be an important chart to watch going into next week. Let's take a quick commercial break. We'll be back with Jeff Hirsch of the Stock Traders Almanac. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close for our show. A couple quick announcements before we bring on Jeff Hirsch of Hirsch Holdings. First off, we welcome your questions. We love hearing from you about the show, about what you're running into, particularly as you are analyzing charts using the StockCharts platform. Shoot us your questions via email, thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Our StockCharts and StockCharts TV channels are up and running, sharing a lot of great content with you. Check out all of our shows. Put a comment below the video you're watching. We'd love to hear from you and review your question live on the air on Friday's show. Upcoming guests next week on Tuesday the 23rd, Doug Bush of Chart Smarter will be coming to us from Brooklyn, New York. On Wednesday the 24th, Andrew Thrasher, founder of Thrasher Analytics. Thursday the 25th, John Kosar, founder of Asbury Research, joining us from Chicago. Our next episode of The Pitch, I'll be moderating a great conversation next Thursday, the 25th, with Dave Landry, Mark Newton of Fundstrat, Joe Rabel of Rabel Stock Research, all frequent contributors to StockCharts TV. It'll be great to get the group of them together. They will each pitch you 5 stock or ETF ideas, then we'll discuss them as a group. It's a lot of fun. You'll come out with a lot of tickers to review on your own, and I hope you tune in for that special as well. Speaking of specials, my next webcast coming up very, very soon is called Sell in May, Trends versus Cycles. I was inspired by having today's guest, Jeff Hirsch, on the show. Wanted to share some of my own thoughts, my experience using the seasonal trends and thinking about what sort of patterns are most relevant and what the markets today are telling us about the likelihood of a sell in May sort of scenario. You can sign up for that event. It's coming up next Tuesday, the 23rd at 1 o'clock Eastern. Go to marketmisbehavior.com/sell in May to sign up for that free event. Let's bring on today's guest, really the expert on seasonality. I'm humbled to announce that I'm doing a Sell in May webcast when I have someone like Jeff Hirsch, who's really the expert. Jeff is the CEO of Hirsch Holdings. He's the editor of the Stock Traders Almanac, my favorite expert and the guy you want to go to for questions on seasonality, coming to us from New York. Jeff, welcome back to the show. How are you?
I'm super. How you doing, Dave?
I'm good. I'm good. It's a really good time to bring you on. I appreciate you being willing to come on in May, when I think naturally people start asking, sell in May, go away. What does that mean? You and your father, Yale Hirsch, really are the experts, I think, in terms of seasonal tendencies and what sort of patterns are most important. Let's go through some of your charts if we could. We're looking, I think, starting with the pre-election year and what that generally plays out like. Talk us through this one if you could.
Well, sure. Sell in May and go away is one thing, but Yale created the best 6 month switching strategy back in 1986, and it's not really go away. It's reposition in May. We actually start repositioning in April if we get a proper technical signal. And if you look at this chart here, you want to be buying in October, is what we did last year. So what you see here is the 1 year seasonal patterns, with the black line being all pre-election years. The green line being pre-election years after a midterm bear, which we had last year. I still declare we had a bear market bottom in October, a textbook midterm bear market bottom. I'm sure Yale was smiling down upon us. And then first term pre-election years, we have a president that is in their first term. I know Mr. Biden has been around for a long, long time, but this is still his first presidential term. And then our wonderful Stock Traders Almanac aggregate cycle, which is a combination of all years, meaning going back to 1949 through 22, and then pre-election years, as well as the third years of decades, the decennial pattern in this particular thing. Last year, we were running a similar version for the midterm election years, which was all years, midterm years, and second years of decades. And then purple, of course, 2023. This is through, I believe, yesterday's close, if I got it correctly. You're going to see some more amplitude in the current year because there's only one, where the other ones are averages of things. Hugging very close to the level of the aggregate cycle. But the key here is, and I highlighted in yellow with these big arrows, is this sell in May period, this worst 6 months is what we call May through October, is where the market tends to go sideways. There's chop, there's volatility. And, we don't just look at seasonals and cycles in a vacuum or trends, as I know you don't either, Dave. We look at what we call the 5 disciplines. Seasonality is our foundation. That's what, we wrote the book on and what we built our business on for, 7 decades now, starting in the 60s. And in conjunction with technical analysis, lovely to be with you at the CMT symposium. Fundamentals, I'm not afraid of fundamentals. First thing my father taught me when we were picking stocks was price to sales ratios, because they can't manipulate the top line so much. And, we look at monetary policy, geopolitics, we sort of group into one area, and politics itself. Not the cycles of politics, but just, like the debt ceiling kind of thing we're having here. And then, of course, sentiment. You mentioned some sentiment earlier, that price is probably the greatest arbiter of sentiment. No argument here. We do look at some of the sentiment surveys. I think put call's been messed with a bit much. VIX has been messed with the different things that are going on with the zero expiration options. And then there's the surveys, the AAII, et cetera. We always like the investors' intelligence, because you're looking at people. You talk about price being important because it's where people are putting their money. And when you survey the investment advisors, the newsletter writers, these are people that are getting paid for their advice and being paid for year in, year out, a present company included. So that's been indicative. And I've showed some sentiment charts of the II bullish and bearish percent that have been effective. But here we have 23, much like 22, tracking the patterns closely. And then we have what's going on technically that you highlighted very nicely. We've got some fundamental issues. We've got the Fed. We've got the debt ceiling. We've got, China, Russia, Ukraine, the usual suspects over there. And then there's the political stuff. So that's what we're seeing here, and it's working.
I was going to say, it's amazing with all of those things you just mentioned, how the price is sort of following the normal cycle very well. And I remember you talking last October about the importance of an October low. And sure enough, it played out exactly what you'd mentioned. So congrats on that. I think that was a brilliant indication of the power of that seasonal tendency, which has played out.
It doesn't happen all the time. Nothing works 100% of the time. We don't work 100% of the time. But when it does set up, it's even more useful.
Yeah. Let's
And
celebrate the wins, however, right? Your second chart, if we could get to it, is talking about the different 4-year cycles and what the 6-month period performance could be. Can you just explain what this is telling us and why May through October is sort of that worst 6 months?
Well, it's sort of a proof that this is the 6-year period is super important. This is the sweet spot of the 4-year cycle that we're just finishing, and then you have this weak spot here, which is the midterm year, and the green line and the green bar is the weakest of that worst 6 months period. But all of the 4-year cycle bars are weak during the worst 6 months, and that is that 6-month period right there that we're looking at, the May through October period. And you can see the green bars are like when it began in the midterm year. That's the sweet spot. It goes into the blue bars on the left. So we're just trying to show everyone the rolling 6-month periods by 4-year cycle that, yeah, the sweet spot from the midterm year, Q4 to pre-election year, Q2 is for real. And it beats out any other 6-month, rolling period that you could think of. And that's what this represents in colors and pretty colors and stuff.
Yeah, it's brilliant, and this is basically looking at all the different 6-month combinations you could pick, and May through October statistically just not the best place out of all of them. I think that's a great visualization to tell that story. Your next chart is really interesting. I'd love to get to this one because you shared this earlier, maybe on social media in a report. Yeah. I remember seeing it. Thinking about 2023 and an interesting parallel, 2011. Why is that a good parallel to use, and what is it telling us now?
Well, we recently learned from our friend Larry Williams and some of the threads that we're on that 1-year comparisons or analogs are valid if they're really highly correlated, as opposed to something having to have a statistically significant number of data points. And Larry's a friend and a mentor. I've known him since I was a little kid. But what we see here is a similar setup. 2011, Democratic president, Democratic Senate, Republican Congress, Speaker with, of the House, a Republican Speaker trying to get things changed. And then you look at the tracking here. I mean, uncanny. Even my brother-in-law, who's not even in the business but loves history, he's just it really tracks here, and it's continued to track since I put it out there. And I annotated it here with the developments that happened in 2011. I guess we could add some things that have happened in 23 with McCarthy's comments to Wall Street, right out of Boehner's playbook. And now we have the, battling back and forth, the showdown. However, we were here last time together, all of us. They cried wolf then. We know they're not going to default. They got close. But they all want to be elected. And here's where the seasonal aspect and the cyclical aspect comes in. Okay, Congress is still on the same calendar. They're going to break for Memorial Day. They're going to take their summer recess. They're going to want to come back in the fall and start campaigning for their party or their seat, who's ever up for whatever it is. And they're going to want to get it all done by then. But the interesting part is that we had this huge, I'll call it huge, this pretty sizable pullback from the end of July to the beginning of August. I think that's about 15.5%, that little stretch right there. But overall, we had an end of April top, April 29 top, and a 19.4% drop to the October 3rd bottom. I just want to make sure everyone realizes it's not going to happen exactly the same way. We may get this blow earlier. We may get it later. I don't suspect we're going to get as much of a drawdown here because we've all been here before. But I think that the analog, the comparison with all the other particulars that are happening, all the similarities, it's worth keeping this in our playbook and our toolbox as well.
That's super helpful, and I love the relationship. Again, what you mentioned about the drawing an analog from one year to the other, but where there are a lot of parallels, right, structurally, sort of with the geopolitical environment, with other situations. That's a really interesting comparison. We have time for one more chart, and I'd love, Jeff, to get to your chart of the S&P 500. We were talking earlier about the S&P just touching 4,200 today. How does the current action that we're seeing this week relate to some of the charts we've talked about so far?
It's encouraging, and I want to make that line thicker, though. I want to. You had some on yours that were those big, wide, faded ones. Just a close above 42 is not enough. It might shift me back into my best case scenario of forecast for this year, which we had initially when we had the January trifecta. But we're going to need to see some market internals, which I didn't mention before, something we look at. We're going to need to see some advanced decline, some new high stuff, some broader based participation to really get comfortable. But 43 and that area of the August highs, which really was telegraphed last year by our aggregate cycle, and that that summer rally hype stuff that everyone was getting into. Everyone got bullish back then. And I've got some, the big downtrend line here that we broke from the January highs. And I know we broke the uptrend line from the October to December bottoms. You can slide that down if you want. But I like to leave the things I draw way back, to see how it pans out. I try to keep myself honest with this stuff. And also, we're an event-driven, cycle shop. We don't just look at the even number of years or this level, but that low from the invasion of Ukraine, which I think we did did we do a show out there last February at the Money Show?
Yeah, that's right.
I think we did that. But we were on the plane on the way out, and we take your plane nap, and you wake up and Russia's invaded Ukraine, and that intraday low is still significant at 41, 100 and change. And I think you had that level on your chart as well.
Yep.
And there's a couple other little areas that I try to highlight and look at. And of course, the 38 to 4,200 level is what we're looking at. But if we break through with confirmation in internals and maybe the Russell, the small caps participating as well, that would help.
I always tell people charts are a conversation you have with the markets. That's a great illustration on your S&P chart, why that's so meaningful. Jeff, listen, it is great to see you. Thanks for coming on the show. We'll talk to you again soon, all right?
Always a pleasure, Dave. Thanks for having me.
That's Jeff Hirsch. Jeff's the CEO of Hirsch Holdings and editor of the Stock Traders Almanac. I'm a longtime reader of the Stock Traders Almanac myself, would highly recommend it. It's a brilliant way of making sense of the markets and embracing the seasonal tendencies, which have usually not been a bad part, a very encouraging and helpful part of my own process. Great take there by Jeff Hirsch at Hirsch Holdings. We need to wrap the show quick and go to the 3 and 3. Let's go to 3 charts in 3 minutes to tell the story of this market environment. Here is chart number 1. I wanted to start with the daily chart of the S&P. I was inspired when I talked with Jeff, saw what we were going to talk about with his daily chart. I had my own daily chart earlier, so here's what I did. I cleaned off my chart 100%. I tend to have a lot of lines going on. It's a pretty active conversation with the markets. And I just started clean and looked at what levels, what trend lines were most important to me. And I immediately was drawn to the incline in the lows from the October low to the March low and drawing that trend line there. And then I'm drawing these clear horizontal levels at 4,100 and 4,200. And for now, those are the most important levels I'm going to be watching, this sort of cluster here. It drives home what a sideways move we've been in, sort of this basing pattern. And if and only if we can get above 4,200, I think that unlocks the potential to go further to the upside. But these are some of the levels I'm certainly going to be watching going into the weekend and into next week. Chart number 2 is Home Depot. What I would argue is for the market to really get materially higher from here, we have to see an improvement in breadth. And Jeff Hirsch mentioned that briefly there at the end about the internals, which have been a little weaker. 100% agree with that. We've seen weaker breadth numbers and not bull market sort of numbers. They're more flat to down kind of numbers. I would argue charts like Home Depot that have been more languishing, that haven't really been participating in the uptrend, probably need to start improving. Home Depot for now has found support around 280. Can it hold that? And not just hold it, can it get it back above the 200-day? Can it make a new swing high and sort of get back to those February highs? If so, I would argue that's a market in a much better position, but that's a big if for now. Finally, Target. Talk about a chart where you can draw a big rectangle pattern. This is what we call a basing pattern. This isn't going to last forever, and at some point, Target's going to get above 180 or below 140, 138, and I think if and when that happens, that's the real signal. For now, we're chopping around right in the middle of the range. Folks, that's a wrap for the show. Thanks so much for joining us every weekday after the close for the final bar. Special thank you to Jeff Hirsch of Hirsch Holdings, editor of the Stock Traders Almanac, joining us from New York. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great night. We'll see you tomorrow.